Top of the morning, everyone. How's everyone today?
Pretty good, working through the sugar hangover from Halloween.
A little bit of that. And I've got my son here today. It's National Take Your Grade 9 to Work Day today. So Connor's here floating around the building, seeing some different things.
Junior Linton making his way up the corporate ladder already, hey?
You guys better look out because he's on his way.
Well, you got a few years before you retire, so you gotta keep the blood flowing.
A few years, maybe a couple decades. We'll see. Anyhow, I guess we should carry on.
Yeah, for sure. So kicking it off with Wealth Talk episode 9, unraveling current events and market trends with Plena Wealth Advisors. As always, joined by Clark and Craig. And a little different format today. We're going to look a little more deeply at what's driving markets. We've just concluded the month of October. We've had 3 negative months in a row now, and it's been a bumpy road for going on a couple of years now. So we wanted to support what we're discussing as a team with some graphics and charts that hopefully will unveil a little bit more detail into what we're thinking and why. So with the recent volatility, I thought, and the consistent headlines that have seemed to beat us over the head with recession and economic slowdown, and it seems like we've been dealing with these concerns for 2 years as we've embarked on this rate hiking cycle and this new environment of higher interest rates. One of the kind of fundamental beliefs that we have, and certainly the characteristics of a good investor that's thinking about the long term is really just a belief that you need to ignore the short-term noise as much as you possibly can. So a couple kind of examples of these headlines that you can find pretty much anywhere you consume your media, but the S&P 500 and NASDAQ are now down more than 10% from their highs of the year, which means they're officially in what's called a correction. Some market strategists expressing that we've got concerns about Europe, China, India, the United States. This is a global problem. Investors have nowhere to hide. The Fear and Greed Index, which is a good sentiment indicator, showed investor confidence sliding even farther into extreme fear territory. Investors run for cover as fear intensifies. I think that's pretty consistent with the environment we're in today. However, these statements are not from recent headlines. These are actually from June 12th, 2012, which is actually a similar environment I felt to where we're at today, where you had a global financial crisis of 08-09, about 3 or 4 years in the rear view, similar to what we had with the COVID correction in 2020. You had the market recovery. You had kind of a situation where the economy was still reeling or evolving from that pretty significant event. And there was a lot of concern about the state of the economy and which way it was going to go. I remember very clearly a lot of very well-respected investors saying the next 10 years was going to be this kind of low growth environment. It was going to be difficult to make money in stocks. There was a lot of concern about a double dip recession. There was actually a lot of similarities in geopolitical landscapes in terms of the Arab Spring was kind of in full thrust, which was causing a lot of concern. Today, we've got a number of geopolitical hotspots. Now, the point to make with this slide is that after June 2012, we saw unfold one of the best 10-year periods in history for the markets, where the S&P 500 tripled in value over the coming 10 years. So despite these concerns, despite short-term headwinds, short-term noise, the market managed to produce one of the greatest periods in history. And I think there's just a lot of similarities to today. So I'm curious, what do you guys think about the current kind of sentiment in the market and where we sit today, and some parallels that we can maybe draw?
I think your points here exactly, these 3 points are exactly what we're seeing in the headlines today. There's a lot of fear out there. The headlines, every time we do dip into one of these corrections, this has been a correction that's kind of going on 22 months now. It's when things are down at these levels that people do think that there's no good news ahead of us. And it is generally the time that things turn, as they did 10 years ago in 2012. So I would agree, a very similar environment to where we're at today.
Yeah, you turn on various business news channels, the plethora of news that comes through email chains, et cetera. Most of it is relatively negative, in particular with, more recent geopolitical events. But, the 20 plus years that we've all been doing this, there's always going to be negative headlines out there. I think the cues and the key here is how investors react to that. How we as portfolio managers, position portfolios going forward, given the new environment. And the new environment, again, is kind of the similar conversations we've had over the last 4 or 5 podcasts, which is a new environment of higher rates, inflationary pressures, a more aggressive stance amongst central banks. And you've seen that, Clark, you talk about a bear market over the past 22 months, or, that bear market, whatever we want to call it, corrective phase, let's just call it, there really hasn't been a lot of opportunity to make a lot of money across various asset classes. And that's not only just equities, it's the bond market, which is probably more unique for a lot of people that are tuning in here. Bond market's always been, kind of the safety net within a portfolio. And I think you're now going into your 3rd consecutive year of negative performance for the bond market. Year to date, the XBB, which is kind of the reference point for the Canadian Universal Bond Index, it's still down, I think it's negative 3% over the past 2 years. You can see that the TSX since January 1st, 2022, it's negative 12%. S&P 500 is down 14%. Even the equal weight, so of the 500 stocks within the S&P 500, if each one of those represents the same percentage, or 1/500th, it's down 17-18% over the past 2 years. So it's been a challenging environment at the end of the day for the majority of asset classes. That filters into even commodities as well. It's been a tough haul. Certainly we've had some periods, such as the second quarter of this year, where we had some good performance in the portfolio. You've had a revaluation again so far in the third quarter.
So what do you tell someone, Clark, that's like a relatively new investor over the last few years that's looking at pretty much all asset classes showing negative, relatively short-term returns? How do you encourage someone in this type of environment?
Yeah, I mean, that's tough. Somebody that would have, let's say somebody that sold a house and they had a lot of cash and they started an investment portfolio January 1st of last year, they would be going through a frustrating environment where, that money hasn't done a lot. I mean, we're seeing some really negative returns here since January of last year. And, I think we're fortunate in portfolios is that we're not printing negative numbers at this point. We've preserved capital pretty well. But whether it's a client that's been invested for 20 years, or whether it's a client that's been invested for the last 20 months, they look at things and it does become frustrating that, hey, we're just not doing anything here. Again, they might not be in the red per se, but 2 years of chugging along and things going up and down, at the end of the day really being flat over that period. I think what we have to do though is look back through history and help those people understand that this is a normal part of the long-term, like a short-term cycle, but a normal part of the long-term investment cycle, that we go through periods like this, and they're normally followed, I would say they're always followed by a period of prosperity where things go up.
Yeah. And I think that's a very important point is, what we've talked about, all this news, that's already been discounted into the price performance, all of these assets that we're referencing. What the best plan is now is saying, how do we adapt to this new environment going forward? And we talked about, I think, and again, in our last podcast, for a balanced investor going forward, the setup is actually probably the best we've seen in 10 or 15 years, because from the 2009 market low to, let's call it 2020, 2021, the bulk of returns within portfolio was always coming from the equity component, because the fixed income was always yielding, less than 2%, let's call it. Wasn't even keeping up with inflation. Well, in the last, 15, 18 months with the aggressiveness of central banks, with bond yields now north of 5%, let's call it, that component within a portfolio could carry some weight and add to total return. So the setup going forward for those who can remain patient, those who have put money in the markets over the last year or 2 years, think about the opportunity going forward. And I think that's where we're positioning portfolios.
Well,
Yeah.
You're right. And when you go back to the equity indexes that you see here over the last 22 months, the average stock in the S&P 500 is down 17.8%. The Canadian market, it's down 12%, only because we've had some upward, pressure from commodity prices. That's why we're not down as much as the S&P. But that's a really good setup for equities. And you've got not only that recovery potential on all those stocks, but you've got now much higher dividend yields on a lot of these stocks. Great stocks yielding 5, 6, 6.5% as well. You add that, Craig, as you said, to what is normally your cushion in a portfolio, fixed income or bonds that are down 12%, with yields far higher. There's not only capital recovery on those bonds now, plus their interest rate as well. So I would agree that things are set up really nicely here. It's just a question of when, when does that recovery happen? I think, going back to Jay's question earlier about what do you tell somebody that's a new investor, or even our long-term clients, again, looking at things over the last couple of years and, things really, really haven't budged. I think, you go back here and again, the setup, looks pretty good going forward.
Yeah. I think just further to that point, this chart here, which Craig, I'll let you kind of explain, does a good job of why it's so important to be patient.
Yeah. So I probably we've referenced these in the past. So it's a great chart by JP Morgan Asset Management. They issue these charts every quarter. And what it shows you is the annual returns going all the way back to, let's call it 1980. So, we've got 40 plus years of data here. And you can see that these bars represent the annual returns each given year. With the majority of those, 32 of the 43 showing positive returns. That being said, you can see on every single year, at some point, there is what's called a drawdown, or at some point the market has pulled back during that calendar year. So far, this chart was till the end of September. As Clark or Jay, you mentioned, we're down about 10% from the recent highs that we saw in the second quarter of this year. That's part and parcel to what we've seen every year over the past, not every year, 32 of the last 43 years. We've had an inter-year decline of upwards of approximately 14%. So we always talk about corrections are normal, pullbacks are part of being a balanced investor. We prepare ourselves for them. Every time we go through one, we want to point fingers at the reason to make a change on a long-term investment strategy. Generally, those are emotionally based decisions, because the proof is evident here that we go through these corrective phases. It's the smart investors, it's those who can remain rational that always come out far better off on the other side of these corrective phases.
And I don't think it takes much to see that after every drawdown in this chart, you see an almost equal recovery in the following year or subsequent years. So it's really just a matter of, had you been an investor through these last 43 years, staying the course, committing to the long term, not committing that cardinal sin of selling into a downturn. And the market's going to go through this. We expect it to. And good investors, like you said, Craig, remain patient, see these as opportunities to put capital to work.
And it's not only, as you say, Jay, there, that when you go through a period where we actually have had a negative calendar year, and there's, 6 or 7 on there, that they are generally followed by, periods where we see 3, 4, 5 years of positive returns. What stands out more to me is what, Craig was looking at, which is, I think almost every year, if not every year on this, we have these inter-year declines of, some small ones, 3%, but a lot of them 10, 15, 20, 25%. And you look at how the year ended up. You can look back, it looks like 4 years ago, a 7% decline decline for the S&P, it finished up 27%. There's another one here down 11%, 6 or 7 years ago, the market ended up 10%. And every time that we were down 11% or 7% or 20%. The feeling that people have, that investors has, they always have this feeling of despair, like we're seeing today, which is, hey, look, I need to change my strategy. The market's going to keep going down, and look at how these years finish. And I think that's kind of the feeling I'm getting today. I'm hearing the same thing from a small handful of clients that normally reach out in environments like this. And that's generally the time that we start to see that, things bottom and that recovery beginning.
Yeah. So again, our favorite topic, we should have called this podcast Inflation Talk, I think, because it seems to be something that we can't move away from, but it is really what's driving the markets these days. Is what is inflation going to do? What are the expectations? What are interest rates going to do going forward? And if we knew all the answers to that, we'd know exactly which direction the market was going to go. But as you can see, the inflation numbers that peaked at about 8% last year here in Canada have been on the pretty steep decline over the last several quarters. We did see in August some inflationary numbers perk back up again, which is really the catalyst for the markets correction that we've seen in these last few months. But these are expectations of economists going forward out into the middle of next year. Where do we see inflation going from here, and what do we think markets do if inflation continues to decrease like expectations suggest?
Well, numbers in both Canada and the States are back in the 3% range. So in Canada, last month, the inflation was 3.8% and 3.7% in the US. So we're back down to some degree in that 2 to 3% range that central banks target. I think that's healthy. But despite that, we are seeing markets continue to correct, as you just pointed out, Jay, over the last few months on expectations that may be choppy, and we may see things bounce back up again. But I think ultimately, this has been an inflation and, as a result, interest rate driven correction. And as the market, like earlier this year, we start to see things moderate, we start to get signals from the central banks that interest rates will stop rising. We've seen the effect of that earlier this year, where the market does start to recover, particularly on the interest sensitive investments, whether it's high dividend paying stocks, bonds, et cetera. And I think that if we do continue to see inflation trend down, that will be the catalyst for a recovery, as sentiment will be that central banks will will stop raising rates and ultimately lead them to decreasing rates as well. But I think, what's a little different this time is that, central banks normally, when we get into a period of economic weakness, are very quick to reduce interest rates. I think this time around, they still have inflation top of mind. They don't want to see inflation peak back up again to 5, 6, 7, or 8%. So I think there might be a lagging effect here where we start to see inflation decline even more than it has, but the bond market and interest rates, not declining as quickly as what we might hope.
Yeah, I think it's safe to agree that the majority, if not all, of the central bank increases of the past 20 months are now in the rearview mirror. I think within the next hour of this podcast, we'll get Jerome Powell to the US. He'll be in another press conference talking about what their policy is. Expectations are they're going to pause. And if you actually look at market expectations into 2024, there's now an expectation that they start cutting interest rates in the back half of next year. You look at economic data, we had manufacturing data again this morning that's coming in softer than consensus. And that trend's been in place now for the past couple of months. So, the work of the central bank, although we've argued has been late to the game, that is making its way through economic data. And you're starting to see that. I think you're even now starting to hear talks of that Canada is technically in a recession, because we've had 2 quarters of declining GDP. So all the setup is there for, for an environment that is slowing, continues to slow, which is bringing down inflationary pressures. Even the major indicator, the majority indicator, which is I think it's the PCE that the central banks follow, it's dropping fast. Goods are coming down, manufacturing is coming down, as I mentioned. Services inflation is still somewhat anchored, but it's starting to trend down. So the signs are there that we're making a lot of headway on these inflationary pressures.
I think we are, but I think where the concern out there is, and this is why markets have corrected over the last few months again, after maybe a false start earlier this year. Look at Jay's chart here, where the expectation is an uptick early next year or late this year in inflation again. These look like numbers kind of north of 4%. I think that's what the central banks are worried about is, taking the foot off the pedal too quickly and us seeing another jump up in inflation. That's the expectation. And I think until the central banks, particularly the Fed in the United States, is confident that inflation is behind us, I think we still have to be a little patient here. I agree the setup is there, but it may just take a little longer. We need to have that communication from the Fed that, hey, we're confident inflation is behind us. And I think we're very close to that. And when we do get that, I think that's the catalyst for probably what will be a pretty strong recovery in both equity and fixed income markets.
Yeah. On the other side of this, what are going to be the catalysts that drive, economic recovery or, a sustainable growth trajectory going forward? I think that's going to be more of a challenging path going forward because lending standards are still very tight. You haven't seen mortgage rates come down. You look at that on a corporate credit, that still remains elevated. You look at personal savings rates, which were elevated coming out of COVID. Those have been spent down significantly over the past 15, 18, 20 months. You look at credit card, a lot of those are at maxed out levels. So the ability for the consumer to spend, I think, is already behind us. So I think going forward, economic resurgence is going to be more challenging to come across. In particular, the longer central banks remain, aggressive or elevated with their policy.
I can add something to that, and it's, the housing market, really. And I think Canada, we talked about this a few podcasts ago, is that the mortgage market in Canada is far different than the States. So I think north of 90% of mortgages in the States are locked in fixed rates for 30 years. Most people at 2.5% to 3%. So there's not going to be that effect as people roll over mortgages that might slow down new home purchases as people are not taking mortgages at 7 or 8% now. But look at Canada. These interest rate hikes to some degree are going to have a lagging effect here on our economy with these 5-year mortgages that people went into 2.5, 3, 5 years ago at, I know some people 1.5, 1.6%, I think on a 5-year fixed. A lot of people are on 2.5%. They're going to be rolling these over, next month, next year, a year and a half from now at 6, 7, 8%. And so I think there's the potential that we see, one of the largest economies in the world, the United States, get through this a little bit better than we do, where we're going to have an effect on our consumer. There's just no way we won't with that type of jump in a lot of these fixed rate mortgages.
Yeah, I think that's pretty clear that there's going to be a divergence in economic performance between us and the US. I mean, never bet against the US consumer, no matter what the environment, but the Canadian consumer, I think, is a little bit more vulnerable in this phase of the cycle. So moving on a little bit to kind of what's going on under the hood in the market. So despite all the inflation, despite all the concerns about the economy, we have seen some pretty strong performance out of portfolio holdings of ours in the market more generally. Just wanted to bring up kind of the difference that inflation is having on what I would consider, and I think we would all consider, some very core high quality businesses that we're invested in. Here we've got Alimentation Couche-Tard, so the owner operator of Circle K's and gas stations across North America and into Europe, doing extremely well up here in the top left hand corner over the last couple of years. Despite inflation, despite interest rates, people still need their convenience foods, they still fill up their gas, all of those types of things. Right next to it, we've got Royal Bank. So Royal Bank, one of the greatest producers of wealth over the last 10, 15, 20, 30 years for most clients, has had a tough couple years with interest rates and the state of the Canadian economy. Cameco, in a slightly different industry, mining uranium. We've seen a big resurgence in uranium and the potential for nuclear energy. Phenomenal performance through this last couple of years. Another great company that most of our clients have owned for a long period of time, TELUS. Higher interest rates have an effect on their ability to on their profitability and their ability to raise their dividend, which has been a big reason to own TELUS shares. Very, very different performance. So what kind of stands out with you guys about these divergent performances, and how can we reassure clients that owning Royal Bank is still a good idea through this volatility?
There's a number of things that jump out here. I think this is a great slide. So the first thing is, and going back to what we were just talking about, how when you go through these environments where the markets and the average stocks are down and you feel this, hey, things aren't going to get better. Look at Royal Bank. I mean, what's that down? 25%. Now yielding north, I think, of 5%, which we haven't seen for years on Royal Bank. You know, is this the time to be selling Royal Bank and putting it into a GIC for the next year at 5%, or ride through that, see what has always been a recovery in these share prices while you get compensated with a 5% dividend? That's one thing that jumps out. The other thing, you know, we're talking about inflation and the effect on these stocks. There's a lot going on here. So you look at Alimentation Couche-Tard, it is to some degree a consumer staple, but they're also a company that has the ability to pass along cost increases to customers essentially overnight. You think about, as oil prices go up, drive out, and you know the next day they change the price per liter of gas. You know, when you buy,
their margin stays the same.
Well, it does. Pepperoni 6 bags of chips or whatever it might be. You know, those are kind of impulse purchases when you go in and you're paying for your gas, and you could increase that bag of chips from $1.50 to $1.70 extremely quickly. And I think that's one thing that's going on when we look at Alimentation Couche-Tard. On the flip side, you look at TELUS. TELUS, just by nature of the industry, they're a highly levered industry, so a lot of debt on their balance sheet. So as interest rates go up, their cost of capital increases relative to a lowly leveraged company like Alimentation. But also their ability to pass along, their cost increases to clients is not that great. We're all probably locked into a 2 to 3 year contract on our cell phone. So those prices don't necessarily go up, or they cannot pass along those cost increases that quickly. You know, the other thing I would point out, going back to Royal Bank, is, that's a reflection of higher interest rates on, from a dividend perspective, but it's also that concern about what we were talking about is what effect are we going to see on the banks from the housing market slowing down, mortgages renewing at higher rates, some people probably having to walk away from their mortgages and things like that. But again, all those things generally come back to the effect of higher interest rates and inflation on the market.
Yeah. And we're showing 4 charts here. We could show another 40 charts, and they look very similar with those that are, as you talked about, Clark, those who are exposed to high levels of debt. They've seen more downside pressure over the past year, 6 months, whatever that reference time frame is, relative to other names that are actually showing some good performance. And I think the key takeaway here is, we get paid to manage portfolios, we get paid to oversee macro environment and make decisions accordingly. But at the end of the day, when we're managing clients' portfolios, this is what we're focusing on, is the host of names that our clients hold across their accounts. And the decisions that we make as portfolio managers are specifically on this here. Is TELUS still a good business that is in a more challenging environment due to the interest rate? Is it something permanently that's changed with TELUS, or is it a transitory period that we're saying, good company, on the other side of this, we're glad we're patient, we held on to it. Where a name like Cameco, which has had a bit of a tailwind because of the performance of uranium, it's got a secular bias behind it. We'll look at a name like this and say, at some point in time, it's going to reach a valuation that we're going to say, let's start to harvest some gains. And that's when a smart investor, you rotate into something like a Royal Bank or a TELUS or any utility or something that has been under pressure and where a valuation is extremely attractive.
We have been doing a little bit of that over the last few months, and we'll be doing a fair bit of that going forward as well.
Exactly. And I think going back to your point earlier, Clark, about, you know, if you just sold a house in the last year, came into some money, and you look at these businesses and you see, okay, I can buy Royal Bank for 25% less than it was trading at a year ago or whatever it is. I can buy TELUS with almost a 7% annual income stream that's very tax efficient. Including bonds in that portfolio, to your point earlier, Craig, about how attractive that market is. There's just a lot of interesting opportunities out there right now. So despite having some of these holdings and portfolios that haven't been great performers, it does present good opportunities to rebalance, like you say, selling some securities that have done very well, putting those funds back into some of these securities that have dipped because of higher interest rates. And my expectation is, as we see interest rates normalize, as we potentially see interest rates gravitate back towards lower levels where they've historically been, some of these names are going to do very, very well over the coming years.
And as I mentioned earlier, you know, we've probably all had a client or two or more that, whether it was this week or this month, you know, question, hey, things going forward, you know, why should I be invested in these things and not GICs? Look at the performance of Royal and TELUS, and not saying today's the perfect day to buy these things, but when you look at that performance over the last couple of years, I'd suggest, you know, that answer should be well known, which is, this is not the time to change a long-term investment strategy because interest rates on GICs just happen to be a little bit higher, and sell some of these great companies. I mean, these are two of the best companies on the right-hand side. There are two of the best companies in Canada. You know, I wouldn't be making that switch myself today.
Well, what's the risk to that? People don't talk about it often. The risk is reinvestment risk. 3 years from now, let's say you locked in your portfolio to GICs, and if that fits for someone's risk profile, that's great. But to do a wholesale change on a strategy that's been in place 3 years from now, what do you do when rates are lower and there's a likelihood that now you're chasing markets that are probably ahead of you? Because at that point, if rates are lower, central banks have reversed course and asset prices will see a revaluation to the upside. It's a vicious cycle that sometimes investors fall into at times like this. We've seen it.
So just kind of to put those four charts in very different industries together, you've got the Canadian market valuation here. So this is just the price to earnings ratio of the TSX index over the last 24 years. As you can see on the far right-hand side, we're currently trading at 12.6 times forward earnings. And this is a little bit of a discount to the average, where we typically trade at 14.5 times. We were all the way up at 21 times earnings in that kind of post-COVID recovery. What do you make of this chart in terms of where the Canadian market is valued and relative attractiveness, and for investors looking to think about where to put some funds?
The simple answer is stocks are more attractive. This is where you start to accumulate a list of names that you want to have in your portfolio if you have cash on hand. You know, the price to earnings multiple, if you continue to see earnings come down, well, that's a different story. But if you look at earnings that we've seen over the past quarter, I think you're at like 65% of earnings are coming in beating expectations. So is it fair to say that earnings are probably have troughed here? You know, I think a lot of that has been discounted in what you're seeing right here. Bottom line is valuations there. This is the opportunity.
Yeah, I think if you look back at some of these periods, 2008, the financial crisis, 2011, the European crisis, you know, those reflect what were the bottom of the market when valuations were that low. I think 2020 is an anomaly here when valuations were high. That was really the start of a recovery after COVID. And I think that's simply because nobody was making money in those first 6 months of 2020. Essentially, the economy was closed. So I think, if you go back and look at these, yes, you're right, Craig, this was the opportunity when we look historically. I think, the other side of the coin, though, is you look at this and the Canadian market valuation is reflecting a negative outlook. And it goes back to what we were talking about. I think Canada is in a uniquely negative position relative to some other countries, given the structure of our mortgage market. And I think we haven't seen the reckoning day for a lot of people in Canada. So I think, this is reflecting some uncertainty too. And I think, again, probably a good time from a long-term perspective, but it's not going to be a smooth road ahead.
Going back to our last podcast, I kind of asked the question, how could we looked at the Canadian economic performance over the last 8 years, and I posed the question, what can we do to make things better other than change tax rates and policy decisions and that sort of thing? But kind of thought about that for a while. And if you were to take the next 10 years in Canada, considering the likelihood that we are going to have hopefully a stable commodity market, we're going to have immigration policy that is going to significantly increase the population, which has a good chance of preventing significant distress in the housing market, where you've just got a huge demand of people that need a place to live. If housing on an individual basis does become an issue because of mortgage rates, hopefully people are still able to sell their house to someone else at a price where they can recover what they've put into that house without taking the losses like we saw in the US in the 2008-2009 financial crisis. And you can start to imagine a picture where the Canadian economy actually has the opportunity to do very well. A strong economy with commodity markets doing well, a strong banking sector, you've got tailwinds of immigration, you've got US economy that's doing well, which always helps to pull us along. There's a lot of negativity and pessimism towards the Canadian market right now. Politics aside, you could see things change course here, and Canada, much like we did in the 2000-2010 segment or era, where you had the Canadian economy actually outperforming in a strong commodity era. I think you could make a case for Canada actually surprising on the upside, but I would agree, Clark, with you that it's going to be a bumpy near term, and hopefully on the other side of that we see some tailwinds emerge.
You are optimistic. I do support part of what you're saying, but maybe it is the millennial in you that just everything is going to be fine. Somebody's going to look after it, right? I'm not sure, but going back to immigration, and I think, from a lot of perspectives, we all support immigration. We've talked about this on previous podcasts, but I don't see how in the near term, and this is what I mean, it's not going to be a smooth ride, how bringing 500,000 people in last year and that continued trajectory in the next few years helps our housing market, helps affordability. I think it just continues to exacerbate some of the problems that we have here in Canada. I would argue it's inflationary as well. You put more demand in our economy from immigration, that might sound good, but if we don't have the supply, the efficiency to meet that demand, we go back, hey, do we see another issue with inflation down the road?
Let's just say they do start to ramp up housing development in a material way, and it's going to be incredibly difficult to do in this interest rate environment. But let's say they do. I mean, the housing minister is calling for a tripling of annual housing production each and every year for the next 5 years in order to meet immigration demand for housing. The tailwind that would create to the economy at large would be incredibly powerful.
Again, I think that's optimistic, and
As long as affordability.
you all have friends that are building houses or renovating houses. They cannot get trades to build a kitchen, let alone 500,000 houses. I personally think it's a tough slog ahead for Canada. It doesn't mean that the market's going to continue to be negative. As I said, I think there's great opportunities out there, but I think to expect that the Canadian economy is going to be a shining star amongst the G20. That's part of the reason why we have diversification in our portfolios. I mean, I'm glad we own Microsoft and Apple and Johnson & Johnson and Nike and, all these great global companies that are not highly dependent just on economies like ours. I don't want to sound too negative, but I think we just have to be cognizant of the fact that it's, I wouldn't be focusing entirely on Canada or heavily on Canada. Just my perspective.
I think you guys both have great points there. And at the end of the day, the economic cycle in particular in Canada here, it's been based off of the availability of credit. And credit is tighter now than it has been at any time going back to 2005, 2006. So until you start to see credit ease off, I can't see the shining star for the Canadian economy. We haven't delevered like the US did coming out of 08, 09. In fact, we've levered up as Canadians. And if credit remains tight, if corporate lending standards, as I mentioned, remain even tighter, I just can't see the Canadian economy firing on all cylinders saying, we're through the worst of it. I think it's going to be a longer, tough haul. You need to see a significant pivot from central banks. And for those who's betting on that over the next 6 to 12 months, significant, 100 to 200, 300 basis point drop in interest rates. I think they're in for a tough haul if that's their outlook.
I think Santa Claus might just be a little more generous this year at Jay's house than it might be at mine, but we'll see.
Again, just to be clear, I'm saying it's going to be a tough, immediate road ahead for the Canadian economy. There's no doubt about that. We've got too much debt that needs to be dealt with, but on the other side of that, I think there's a lot of room for improvement that should not be overlooked in terms of what the Canadian economy potentially presents with names like Royal Bank, like TELUS. Look at TELUS. We did more than 1 million new immigrants last year, not 500,000. We're expecting to do another million this year. Those 1 million, 2 million every year of new immigrants, they need cell phone plans. Who are they going to get them from? Great companies like TELUS. So just to wrap things up here, good slide, just kind of on general investments. Craig, you want to walk us through this one a little bit, or?
Yeah, again, I another chart from JP Morgan Asset Management. So really what it shows you is a balanced portfolio. So, let me back that up. The green bar charts here is 100% stock portfolio. The blue would be 100% bond portfolio. And the gray shaded area is going to be a 50-50 mix between those two asset classes. And what it shows you is the variability of volatility over various time frames. So on the left-hand side, you can see that the volatility of stocks on a one-year basis can provide anywhere of upwards of 47% return all the way down to a 39%. That's similar to the previous chart we showed you. Bonds historically have provided less drawdown. As we noted at the onset of this podcast, we've had 3 years of negative return for the bond markets. Balanced portfolio somewhere in between. But as you start extending that time frame, whether it's a 5-year rolling period, a 10-year, 20-year, let's focus on the 5 to 10-year period here. You can see that negative returns, whether if it's 100% stock portfolio or a balanced portfolio, the odds significantly are stacked in an investor's favor. And as we keep reiterating here, now that you can actually get return from that 50% of a balanced portfolio being the fixed income side of things, is it safe to say that the next 5 to 10-year rolling rates of return look very similar to what we've experienced going back over the past, 72 years on this chart?
Yeah, and what I take out of this, I think it's a great slide. It's Warren Buffett's comment, it's time in the market rather than timing the market. Those that think they're going to be jumping around every year, when you're down 39% and be able to get back in at the right time, when as time goes on, just riding things through, generally you're going to see positive returns over that period of time.
I think that's exactly it, and a great place to finish. It's just stay invested, be patient. Good times will come, and we will do just that as we stay invested in our great companies here in Canada and elsewhere.
Thanks again, Jay, for hosting the podcast. We always appreciate it.
And given you're so positive today, Jay, I'm going to let you buy me lunch today.
Thanks, guys.
Take care.